Oh, that's scary. We need to talk about risk management, guys. Follow me. Okay, guys, we need to talk. Time is ticking. Right, we're talking about risk management today. So the first thing is sector diversification. What is that? I'm going to give you an example. Maybe you're thinking about investing in Exxon, which is the oil company. So you buy some Exxon stock. Nothing wrong with that. So you put 5% of your capital in Exxon. And you also buy Chevron because you're thinking, well, Chevron is a different company. So if something goes wrong with Exxon, then Chevron's gonna be okay, right? Wrong. Okay? If you put 5% in Exxon and you put 5% in Chevron, you are not diversified. They are both oil companies, and what happens with one oil company will affect the other. However, this is the solution. If you invest, let's say for example, 5% in Apple stock, Apple's got nothing to do with oil. So it's likely that it will not be affected by what happens in the oil industry. So this is the first point to do with sector diversification. Now, the second point I would like to address you guys with is correlation, diversification. What do I mean by that? It's a bit of a complicated word, yeah? So, what's going on there is basically to do with the correlation between different assets. It kind of connects to the last point I said regarding Exxon and Apple. They are two different sectors, so they are obviously inversely correlated, right? So I want to give you another example how you can do inverse correlation. There is something called the VIX. Now, generally, if the stock market goes up, the VIX will go down. So it performs inversely. So if you want to hedge yourself, which is practicing good risk management, you would buy the VIX as the stock market goes up, especially if you are anticipating a correction in the stock market. Another point I want to give to you is there's this ETF called TZA. This is a ETF of the Russell cap stocks. Yeah, we have seen in the stock market these Russell stocks make phenomenal runs and returns. But if you are expecting a correction in the stock market, you could still hold your Russell-based stocks, but also buy the TZA. This is how you diversify yourself when you're practicing good risk management. And the next point, this is relating to position sizing. Now, when you look at an investment, you need to kind of quantify to yourself, how much risk am I taking by buying this stock? Some stocks are more risky than others. So let's talk about penny stocks. There's one penny stock I know, it's called ADMP. They've got a chance of being FDA approved for treatments for coronavirus. If they are approved, maybe the stock will go from say $1.50 to $10. That's a phenomenal return. However, if it doesn't work out, that stock could also lose half of its value. So with a stock like that, it is very volatile, and you would not put 5% of your account in it or 10% of your account in it, because you could lose a lot if you lose half of the value of that stock. But you would perhaps put 1% in, because if you're right, you can make a lot, and if you're wrong, well, you're not going to lose much anyway. So that is appropriate position sizing in relation to the risk. Now, the next point I would like to talk to you about is actual risk exposure. So let's talk about Apple. Maybe you've got, say, 10% of your portfolio in Apple, and you're expecting good things. But to limit your risk exposure, you might want to set a stop loss. A stop loss of, let's say, if the stock drops 20%, that you're out of the trade. So your actual risk exposure in Apple, it is 20% of 10%, which is 2%. And that is your risk. So that is how you use a stop loss, and that's how you manage risk. Right. And the final point I would like to talk to you guys is about liquidity. So, sometimes it's just better to have more cash sitting on the side, because you are looking at the market and you are anticipating that maybe things are getting a little bit heated, people are turning a little bit speculative like they are now. So it's better to have more cash reserves. But there's also another good point. If you are constantly always expecting a market correction and the market to crash, you will actually lose. You will lose the opportunity to make greater returns. So this is a careful balance here. And a lot of portfolio managers, they might change their actual cash exposure in the market anywhere from, say, 5% to even 30-40% if they anticipate a pullback in the market. Okay? So this is how you constantly are changing the liquidity in your portfolio in relation to the risk that you perceive in the market. Right? So that's the final point I have mentioned regarding liquidity. I would also like to mention eToro here. They have actually decreased the minimum position sizing, which is beneficial for the users of eToro because we can participate by being in stocks with a smaller funds. So for example, the minimum trade size for stocks and ETFs is $50, crypto $25, and currency $1,000, commodities $1,000, indexes $1,000. So that's the great thing about eToro. Yeah, it allows us to be in the market and practice good risk management. Yeah, and every popular investor on eToro has a risk score, which is relating to all these points that I just mentioned. eToro calculates people's risk based on a lot of the content that I just mentioned. So if you also want to control your risk score, then you should perhaps follow the advice that I've just given here. Yeah. So if you guys would like to hear more from us, we have a Discord group. You feel free to join that. If you're not on eToro, then just click the link below. You can create an account. And if you would like to copy our trades or just see how we're doing, I have a profile. Khalil, he also has a profile. So feel free to follow us. Take care, be zen, and practice good risk management. Don't risk it all. Take care, bye bye.